And in fact, our trickling might be slowing, so I might even just say we'll get started now. All right, I'm gonna hand it over to Malavika, who'll get us started, and then we'll jump in.
Awesome. Thanks, Vivian. Good morning, everyone. Thanks for joining bright and early on a Tuesday. My name is Malavika Krishnan. I sit in corporate responsibility at JP Morgan Chase, where I help manage our philanthropic portfolio focused on improving financial health outcomes for consumers, particularly those living on low to moderate incomes. At JP Morgan Chase, financial health is really built into everything we do, and we believe that the strength of our business is tied to the communities we serve. So we are leveraging our business products and services, as well as seeding innovative solutions through our philanthropic initiatives, like with Ideas 42, to ensure consumers are able to manage their financial lives with ease, be resilient in the face of economic shocks, and ultimately get on a pathway to building wealth. In particular, we know how fundamental credit is to financial health, both for short-term cash flow management and managing those emergency expenses that are bound to pop up, but also as a building block for economic mobility. It's why we're excited to support Ideas 42 and their work on leveraging behavioral science to improve both the application and repayment process for small dollar loans in this project, and beyond, as they develop and test solutions that help consumers protect and improve their credit. As we've learned from our work with them, it's not just about changing consumer behavior, but designing systems that meet consumers where they are to maximize their outcomes, while generating proof points that can help scale best practices across the industry as well. So I know the team has some exciting results with their pilot on small dollar loans, so I will pass it along to Anna Vick to dig into those findings, and hope you'll find insights to apply to your own work to improve financial health outcomes for consumers.
Awesome. Thank you so much, Malavika. Okay, so today we are going to be discussing how behavioral science can be leveraged to improve timely loan repayment. Before diving in, we want to thank the JP Morgan Chase Foundation for their support of this work. And we also want to thank our partner, People's Advantage Federal Credit Union, we call them PAFQ, for their collaboration and commitment throughout this project. Special thank you to Justin Cousins. He is one of the panelists today, and he will be joining us to talk about this work. Okay, so this slide can give you a bit of an idea of what we'll cover in today's session. As I mentioned earlier, we're really excited to share with you the results of our pilot study, where we tested solutions aimed at facilitating timely loan repayment. Before we share those study findings, we will start by giving you a brief overview of the project itself, the behavioral barriers at play, and then the designs that we tested. Like I mentioned, we will then move to pilot findings, and we'll hold some Q&A at the end of the session. So if anything comes up that you want to ask us about, feel free to use the Q&A feature at the bottom of your Zoom window, and we'll try to get to as many questions as we can in the end. First, a little bit about Ideas 42 for those of you who are not familiar with us. Our organization is a nonprofit, and it generally operates as a research and design consultancy. We have been super lucky to collaborate with all kinds of organizations across the public, private, and social sectors, and across a variety of focus areas as well, one of which is financial health. And on our financial health team, we draw from research across multiple disciplines, really to understand how people make financial decisions and take actions in this complex world. And our ultimate goal is to create a financial system that works for everyone. Okay, so people across the country are increasingly turning to personal loans to meet their financial needs. However, we know that there are biases in a lot of the systems that lead to disproportionate financial strain and hinder equitable access to credit for certain groups. For instance, we know that people of color are especially exposed to financial disruptions, and on top of that, they're disproportionately targeted by high costs and predatory lenders. And these trends only further highlight that people need access to affordable credit options as a way to address financial challenges. Now, small dollar loans have the potential to meet this need for affordable credit. So a quick overview of small dollar loans. They are short-term, low-cost loans of generally $2,500 or less, and they can be up to 15 times cheaper than the high-cost predatory loans people often turn to. More often than not, loan decisions are made based on alternative data like cash flow, how long someone has been a customer of the financial organization, and other factors that can be more equitable than using someone's traditional credit score. And they're offered by all sorts of financial providers, from banks and credit unions to small community development financial institutions and even some non-depository lenders. But there are still questions about whether affordable credit products will actually live up to their promise. On the one hand, and we know this from behavioral science, simply offering a product or having it available doesn't mean that people will actually use it or improve the financial health for those consumers that do. On the other hand, we have also heard from providers and having questions of whether they can make some of these affordable loan products sustainable and offer them at scale. So finding ways to improve repayment is key for these products to improve a member's financial health, for example, by lowering overall borrowing costs for the member and boosting their sustainability of the institutions who offer them, for instance, by lowering product costs. And luckily, we know from past projects that creating a context that facilitates and encourages action, in this case, loan repayment, is exactly the kind of space that offers a ton of opportunities for behavioral design. And we will show you just how much impact behavioral designs can have when we share the pilot results over the next few slides. Okay, so that was a little bit of context that leads up to why we teamed up with PAFQ, who let us peek behind the curtain, if you will, and improve their services for their clients. Our project goal was to improve timely repayment of SDLs, as I already mentioned, while also helping the members avoid negative consequences of being past due. And so why do we care, right? If something like this is scaled and scaled and scaled over time, then we would have more consumers with low and moderate incomes using these loans in ways that help them protect their credit. And to achieve both of these goals, the products need to be designed understanding the scarcity context of the clients that use them. Okay, so you will be hearing a lot about PAFQ's small dollar loan. It's called Fast Cash. So I'll hand it over to Justin to briefly give you an overview of the product.
Thank you, Annabeth. I appreciate that. So our Fast Cash product is something that we offer through QCash Financial, where it allows us to target members that are it does not require a credit check, so they can borrow up to $2,000. They can only take it only takes up to about 1 minute for those funds to be dispersed into their account after the application phase. And there is no credit check. So it's based purely off of the member's deposit history and relationship with the credit union as a whole. The big focus on this product, especially with us being a CDFI, is honed around allowing members to take advantage of a non-traditional loan product, if you will, build credit off of that, understand how those behaviors helps that member to be able to borrow responsibly. And then in turn, that will help them to be able to take advantage of traditional loan products with the credit union. So that way, then we can then introduce them to the world of credit, where they are now borrowing with those traditional products and building credit and saving money along the way.
Awesome. Thank you so much, Justin. Okay, so to better understand the context of these fast cash borrowers, we conducted multiple rounds of interviews with both current and past fast cash clients, as well as with staff from PAFQ, and we identified 7 main barriers that hindered timely repayment. I want to highlight, though, that while today I am presenting these barriers specifically in the context of fast cash, they are part of a larger body of work around repayment more generally, and we've seen some of these same barriers showing up across product types. So going back to fast cash, we found that some of these barriers showed up during the application phase, that is, while a member was setting up their loan, and others were more prominent at the time of repayment itself. So to contextualize the application barriers, the ones on the left on your screen, it's important to first mention that PAFQ offers a lot of flexibility for people to determine loan preferences that work best for them. And that is, of course, great. So that means that their loan is super customizable. A member can select things like the loan size, so how much they want to borrow out of the total amount they've been approved for, and also select a preferred due date. Now, because the application itself prioritizes ease and speed, sometimes the framing and presentation of these loan options can make them easy to miss altogether. So many borrowers stuck with defaults that were not right for them. Now, even if a member made active choices during that setup, it was not always easy for them to determine or to visualize how these choices translated to actual payments in the future. And finally, we found that the consequences of being past due were not always evident at the time of applying, and people tended to be unaware of them overall. We also identified 4 repayment barriers, and these are pretty straightforward. Again, those are the ones on the right hand of your screen. So we learned that members had limited prompts for action before and after a payment due date. We also learned that seeking support before or even after a missed payment could often be challenging. And then we also learned from members that sometimes they had insufficient cash flow or competing financial priorities. Now, for this project, we only focused on the ones that are on screen because things like insufficient cash flow and competing financial priorities are not really behavioral barriers, but they are really important to keep in mind, when we're thinking of designing these types of products and solutions. Okay, so now I'm gonna move into the designs themselves meant to address those barriers. So when people tackle repayment, they often only think about the repayment period itself. But actually, time and time again, we see that the early stages of learning about a product and the decisions made at the time of applying itself play a really big role in people's repayment behavior in the future. So as you can see on the screen, we tackled repayment by creating designs that fell within 2 buckets, if you will. We address repayment, and that's what you have in the gray box on screen, by redesigning the Fast Cash landing page, which gave borrowers crucial product information, as well as by redesigning aspects of the loan application itself. And again, that was to address repayment at the beginning, earlier stages, so during the application phase. We also created text message reminders before and after a payment came up to help people make their payments on time or seek support if they were unable to pay, and that was to address the repayment instance itself. And I'll be giving you a little bit more detail on these designs over the next few slides. Okay, so as I've already mentioned, one of the things that we learned when we spoke to real clients was that not all of them were aware that there were penalties associated with being late on a payment. And we realized as well by reviewing the product page that these were easy to miss on the original product page and application. So our redesign focused on elevating penalties to the forefront so that applicants knew what these were from the get-go. And we did that by making the penalties hard to miss, but easy to understand by displaying them on a timeline. And we also created a moment of pause for members to consider what these were before moving forward and getting charged the application fee. And before showing you the other design changes that we did, I do want to pause and say that I realize how making negative consequences more evident or like more salient can sometimes feel really uncomfortable or risky. And I get it, right? We don't want these to be what stops people from applying to these affordable credit products. But we have heard time and time again that clients appreciate having these penalties listed up front. And for many, this type of upfront transparency even signals trustworthiness, and it can really increase the credibility of the provider. Okay, so as I mentioned earlier, the Fast Cash application was designed to prioritize ease and speed. And again, you can see why this makes sense. Making that application super easy can really help us ensure that people go through with it instead of getting off put and then turning to a payment lender, which we of course do not want. On the other hand, going through that application quickly can also have some downsides. So for instance, while PAFQ allows members to select how much they want to borrow out of that total that they have been approved for, the ability to select how much to borrow was not always obvious, with many clients borrowing the total that they were approved for, even if it was more than they actually needed or could comfortably pay back. So what did we do? Well, we modified the type of information on screen to encourage active choices and help borrowers really visualize the impact of said choices. So we did that by giving members an overview of what they could expect before the application. So we highlighted what aspects of it were modifiable, letting them know that they could select a due date and also the total loan size that they wanted to borrow. And we also provided some easy to digest examples of how selecting different loan sizes would reflect on later payments. Okay, moving on to the text message designs. In our field, in behavioral science, we often use reminders to address what we call limited attention problems. which is a fancy behavioral science term, but in short, it really just means that humans can only process so much information at any given time. So when we pay attention to certain things, hopefully you guys are paying attention to me right now, we often do so at the expense of ignoring other things. Limited attention problems are something that we are all prone to, right? Like if you're listening to this, you might miss a text message on your phone, but they are often exacerbated for people that are living in conditions of financial scarcity. And by that, I mean people that are having to juggle multiple financial responsibilities all the time. So with this in mind, we crafted 4 different reminders, and these were to be sent before and after the person's due date. So for the sake of time, I won't be going into the details of the text themselves, but I just want to highlight, we did user test the language and the timing of these with Fast Cash clients to understand what type of language was the most helpful and really resonated for people at different points in this timeline that you see. Okay, so the first thing we sent out was a payment due date reminder, and that was sent 5 days before the due date. And the thought behind that was to act not just as a reminder, but also to provide enough time for the client to take action if necessary. So for instance, if they didn't have enough funds in the account, this would be sent ahead of time and give them enough time to go ahead and add the funds before the deadline came up. We also send a 1-day past due message because we know from past work that people really respond to nudges right before it or right after something is due. Now, the goal of this particular reminder was to reach clients who had easier, if you will, problems to solve. So things like they forgot to transfer that money over, or there was an issue with their direct deposit that they weren't aware of. So we wanted to help these folks catch the problem early and take action so that they then wouldn't face any consequences down the line. And then finally, we also sent reminders at days 10 and 14 because we wanted to make sure that people were aware of the upcoming penalties, which hit, as you can see on screen, at days 15. That's when they would receive late fees or potential debit freezes, as well as at day 30 with the traditional credit reporting. And again, I just want to mention, I know that highlighting penalties can feel a little bit scary, but people have lives, and we just didn't want them to suddenly go get gas only to find out that their debit card was frozen or to find their credit scores had dropped. So we really made these upcoming penalties clear in those reminders, while also being very conscious about the language that was used and making sure it was friendly, and also providing within those text messages an easy way for people to get in touch and to seek help to help them avoid said penalties. So now we are going to move into the results. I'm going to go ahead and stop sharing my screen so that my lovely colleague Andrea can share those results with you.
Thanks, Anna Vic. Just going to share my screen now. Does it look okay? Awesome.
It does.
Wonderful. Excited to share these results with you all. Diving right in, we're going to start by just presenting some of our key research questions. So when we run a pilot, in order to evaluate if our intervention had any kind of effect, we need to really measure specific outcomes. So here's a list of what we were really digging into. So the first thing is we were looking at, did our designs reduce the volume of past due borrowers who are past due? So keep people from becoming past due in the first place. The second one is, for those who were past due, did we help them make payments sooner? So are we helping them avoid those negative consequences that Anna Vic just described? And lastly, from a financial risk perspective, are we reducing the percentage of balances that are delinquent and reduce the overall risk of the portfolio? So those are the main things we were trying to measure. Okay, so just to give you all an overview of our pilot timeline, we're going to dive into this graph later on, so I'm not going to go into detail, but what we're looking at here is the percentage of delinquent fast cash balances. For right now, we just want to highlight that we started collecting data in December 2023, and we launched our application changes in July of 2024. And then we launched our text intervention in January of 2025. And so when we share our text message pilot results, you'll hear me compare the pilot period to the pre-pilot period. Because we launched our text for 2 months, we compared the 2 months prior. So November and December of 2024 are what we are calling our pre-pilot, and the pilot period is January and February. Now in this graph, the labels down here connote the end of the month. So this vertical line that you see for launching our text message in January of 2025, it looks like it's on December, but it's the last day of December or the first day of January. Okay, so now diving into our application results. So we showed you all some of the changes that we made to the application to encourage people to intentionally pick a due date that worked for them with their cash flow, and to encourage them to be mindful of how much they were taking out. So what we found when we made these two changes we changed the default due date, and we made the option to change your loan size a bit more obvious. And what we found was that overall, people tended to stick with the default both before and after our changes. So regardless of what we changed the default to, most of the time, people were going with whatever option was already pre-selected. So the takeaway here is to choose your defaults wisely, because chances are people aren't going to change from what's already there.
Now, Jerry, I want to jump in here and ask Justin to share a little bit too. So Justin, you previously told us that some of the changes that we made to the first due date on the application had an effect on the calls you received. Could you share a little bit more about that?
Yeah, absolutely. So one of the biggest issues that we had early on with this product was the members that they accepted the defaults frequently, and they still do today. But when they were accepting the defaults, a lot of times they would put their due date right up against when they actually opened the loan, sometimes even the next day. And so whenever the loan would book, and then the payment gets pulled the very next day, and a lot of times from the funds that they needed access to at the time, that's why they took out the loan. It prompted a lot of phone calls. And so for us, a big part of why we offer a product like this is because we want our members to have ease of use without having to contact the financial institution to take advantage of a small dollar loan product. And so when the opposite is happening, those phone calls that are coming in, that to us, it rings an alarm of, okay, we probably need to change something here. So when we made those changes that are highlighted on the slide and made it more obvious of what the options are that they do have and what control they have and what they need to accept and to move on to make sure that the loan funds like it needs to, those phone calls, for all intents and purposes, they went away, because now the members are understanding exactly what's needed from them. We're not being contacted by members that are having issues with the application phase, and those phone calls are now migrating to members who need help based off of the messaging that we're sending them after the loan has been booked and during the repayment phase, which is where we want those calls to come from. So that way we can then intervene to help their success overall. So the call shifted to where we wanted them to shift to. So I'm happy about that.
Great. Thank you so much, Justin. So now digging into some of the results from the text message pilot. So just to give you all an overview of what we found, the first is that we did find that fewer borrowers were past due during our pilot, and we reduced the average daily proportion of past due borrowers by around 8%. We also helped past due borrowers make payments sooner. So for those who were past due, we helped them make payments earlier on, especially driven by folks who were making a payment around 5 days after their due date. And the proportion of fast cash balances, so the financial risk, the financial risk of the portfolio also dropped by around 19%. And the exciting piece for us who are a bit nerdy here is that 2 of these results were statistically significant, and we will dig into each of these. So let's dive into the first key takeaway. We're going to look at the daily proportion of delinquent borrowers and how that changed both during our pilot, which is the orange line, and before our pilot. Sorry, I said that backwards. So the orange line is before our pilot and the blue line is during our pilot for those who did receive our texts. So what you're looking at here is the proportion of delinquent borrowers. What that means is on any given day, there are a bunch of loans open and some percentage of them are past due. So this plots how that changes day to day. So the blue line is pretty consistently below the orange line here, which was great for us because it means that the percentage of past due borrowers was lower on most days that you can see here during our pilot when the texts were being sent versus before. So this was already really exciting, but we conducted more analysis to understand if the difference between these lines was just because of chance or because of our intervention. And what we found was that it was because of our intervention. So this graph, it shows the same data that we were just looking at, but in a different format. It's a bit, this is the nerdier part. So I can answer questions about this chart specifically if you have them in the chat. But basically the gist of it is that the average daily proportion of past due borrowers decreased by 8%. So the orange is before we sent the text and the blue is after we sent the texts. And so what this means is if the average daily proportion of past due borrowers dropped by 8%, what that means is that this is a result of our payment due date reminder. So that's the one that's helping people avoid being past due in the first place. And exciting again for us who enjoy regression analysis is that you could see that the p-value here is 0. What that means is it's really rare. It just means that this difference was statistically significant and wouldn't have happened without our intervention. So this was all about, that first result was all about preventing people from becoming past due. And we did see that our text helped people avoid being past due. But what about for those who did end up being past due? We wanted to look at how those folks behaved during our pilot when we sent the reminders. So what you're looking at here again, the orange line is before we sent the texts. The blue line is during our pilot. And what we're looking at here is the percentage of borrowers who are past due at different points in time. So as time goes on, you can see that we plotted what percentage of overall borrowers are still past due as time goes on. So this is the percentage of borrowers who are delinquent. And what you can see here is that there are two main points where these lines are different. And I also will just note that the vertical dotted lines are when we sent those reminders. So at 1 day, at 10 days, and at 14 days. So there are two main points where these lines diverge, where they're bigger. And the first is around day 14. And the second one, which is a little bit of a bigger gap, is around day 4 to 5. And we were really excited about this bigger space, and we wanted to dig into that again and kind of see what was going on around day 4 and 5. And what we found was that this was in fact where we were having the biggest impact. So at both days 4 and 5, we saw an 11% decrease in the percentage of delinquent borrowers. And so both of these results were also statistically significant. So what that tells us is interesting because we saw this impact happening at around day 4 to 5, this biggest gap between the lines, but we didn't send a text at day 4 or 5. We sent the text at day 1 after being past due. So what this tells us is that the 1 day past due message is likely taking a couple days to kind of kick in and translate into real behaviors. So that makes sense given that when you get the reminder at day 1, it might take you a few days to get your funds into the account or to kind of do whatever you need to do to get that payment in. And so that's kind of the 3 to 4 day lag that we're seeing. This also makes sense from a behavioral perspective that this is where we saw the biggest gap because text messages are really addressing an issue of limited attention. So forgetting or not realizing that something's maybe wrong with your direct deposit. So it makes sense that the text messages had the biggest impact earlier on in time because those are the folks who just needed a little nudge. And that's kind of the chunk of borrowers, of delinquent borrowers who are more movable. As time goes on, the difference between these lines is smaller. And that kind of makes sense because those are the folks who are probably having difficulty with cash flow or insufficient funds So a reminder by itself is likely not going to be able to make that big of a difference. A reminder by itself cannot solve those problems. So this makes sense as to where we see the biggest gap, coinciding with the borrowers that were most likely to respond to our text messages. So digging into the last kind of piece of results is the financial results. And here we're using end of month snapshots. So what that means is for any given month, we collected data of how things looked on the last day of that month. So here's the chart that we started off with at the very beginning, and we're going to dig into it now again. So what you're looking at here is the percentage of delinquent fast cash balances out of the total balances. And what you can see here is that it's plotted starting in November 2022. And we wanted to kind of collect more data and see a wider view of this so that we can see the trend over a longer period of time. And what you're looking at is the fact that when we launched our new application, which was over here in July, you start to see the line kind of go down. And again, this other dotted line here is when we launched the text messages. And what you can see is that there are two main moments where the graph starts to kind of go down. So when we looked at this, we saw that the average proportion of delinquent balances dropped by around 20% between July of 2024 and October of 2025. So this is after we made those application changes. And then another 19% drop happened between the no text months and the text months. And you might look at this graph and say, well, there are other points in time where you could see the graph going up and down, up and down. And that is true that there are times where the line is dropping, but as you can see, it's mainly between 1 month to the next. So any changes that happen between 1 month to the next and just go up and down, that could just be noise. So what's interesting to look at is that if you can see here, when you look at it horizontally, these drops that occurred after our application and after our text happen over multiple months. And so that really had not happened prior to our changes.
And I think one thing I'll add here also, at least for me when I'm looking this also, is that there is an upward trend before this. So even though it's going up and down, there's noise in there. It's sort of expected when you're looking at this kind of data. It does generally have an upward trend, whereas we're kind of that trend has been booked and now it's switching and going down instead. Justin, I want to have you hop in here because you've mentioned to us that this is a volatile product, but there are clear trends, there's seasonality. Could you sort of speak to the trends that you're seeing in the graph and what this means for you?
Yeah, for sure. So I guess if you start at the left here a little bit, the product, we launched this in August of 2021. So we were still getting our feet wet within the first year. And so when you pick up at November 2022, a lot of the volatility you see, this is a payday alternative loan as designated by the NCUA. So the intents and purposes are initially for members to be able to pay these back quickly. So there is a lot of pay down activity that will fluctuate the overall loan balances when you're looking at calculating your delinquency ratios here. And so in terms of repayments, members typically have a harder time repaying these loans when there's tight cash flow. That's typically around the holidays, before tax season. Also when COVID benefits expired as well, that also played an impact on what we could tell looking at this timeline. All of those things played a factor in seasonality trends as well. But what's different about the right side of the graph is that overall you see a steady downstream of behaviors that any financial institution would want to see from those who are trying to borrow responsibly is, okay, now that responsible borrowing has picked up big time for us overall. You still see a little volatility there between November and December, but as I stated, that's when cash flow is tight and you do expect to see delinquencies rise during that portion of the year, but they did fall dramatically once we instituted the text messaging at the beginning of the year as well. So positive things there for sure.
Something else, I think when we first showed you this, especially with the longer time horizon, you mentioned that there was things in here that sort of pointed to why you wanted to start this work and sort of that. Yeah, could you speak to that as well? Because I found it really, I think others might find it interesting as well.
Yeah, for sure. So when you look at 2023 and 2024, we had a period of where we were trying to find our way of, okay, what's the right underwriting technique to have here, and also to try to help members borrow responsibly and not to have delinquencies get out of control, because we like the product. We even bring members into our credit union as an acquisition tool, utilizing this product as saying, hey, we have this product that helps solve short liquidity needs that you will have, especially those who live in CDFI census tracts. And so, you know, so when you start to see your delinquencies continue to be extremely volatile or continue on an upward trend, that makes us pause and say, okay, we need to figure something out here. And when we made that known, that's actually what led us to our partnership with you all. Is like we needed to solve this problem, and so I'm glad you guys came on board to help us out with that for sure.
We're very glad too. And yeah, we were also very pleased to see this longer time horizon and kind of how the line starts to change direction a bit. So this graph is showing the proportion of delinquent fast cash balances and how that went down overall. But the other thing that we looked at was when you looked at the makeup of the delinquent balances, we wanted to see if those changed at all. So this was interesting. So what you can see here is that the size of the rectangle overall has gone down. So that just means that the amount of delinquent balances went down. And we know that this was around 24% lower after our text messages compared to our text messages. So this is the overall amount of delinquent balances. But beyond just shrinking the total, you can see that the breakdown of where the delinquent balances are coming from is also different. After our texts, the delinquent balances coming from borrowers that were over 30 days past due now make up a bigger chunk. And this kind of makes sense because the reduction in the total amount must be coming from those who are under 30 days past due. So basically what this means is that our designs really targeted those who were 0 to 30 days past due, and those are the folks who we see more movement with. So the orange and the green are the ones that are going down, and the blue might have just kind of stayed the same because those folks didn't really get exposed to our intervention if they were already over 30 days past due. But now, because that didn't move as much, it makes up a bigger chunk of the total. So I know this is a bit trippy to think about these percentages and how they changed, but happy to answer any doubts or questions also in the chat.
Yeah, and Justin, during one of our conversations about this data, you mentioned that this is a useful finding from a collections perspective. Could you share a little bit about that?
Yeah, absolutely. So for us, this change was great because it brings to the surface members who needs help, right? And so it allows us to have it a lot more effective targeting around identifying those members who need more intervention. So those who had the ability to pay and they could quickly cure the account, so to speak, it allowed them to jump in and make those payments where we were not exhausting a lot of manual effort to try to resolve those needs. This helped segment out quickly so we can target and say, okay, now I know exactly who probably needs our help, or these folks have already gone beyond 15 days past due, and now the debit card may be turned off, and I see where they may be trying to use the card. It allows us to target those members specifically to work through a solution, so that way we could get them back on the right track a lot more effectively.
Thank you so much, Justin. And you've already started to summarize some of the takeaways that we'll end on before we jump into a discussion or Q&A with you all. So just to kind of summarize everything that we've been over, here are the core takeaways. Reminders can really be an effective, low-cost solution for past due borrowers who are facing issues of limited attention. And it's really helpful because it segments out those borrowers who really just need a little bit of a nudge, as Justin just mentioned. The key thing is timing. So it might take a couple days to see the effect of a reminder, and this can help you plan accordingly about when it might be most helpful to send it. The other key takeaway here is that past due borrowers who are facing more structural issues, like insufficient cash flow, those folks might need more support, and a reminder alone might not be sufficient. So reminders can help segment out those borrowers and make it easier to identify who are those folks, as Justin just mentioned, that really need a bit more help, and to direct resources to those folks instead of kind of using up staff time and resources on the people who really just have a limited attention issue. And those are the people who would most likely respond to a simple reminder. So I know we covered a lot of ground. We're going to jump into some Q&A. And I'll stop sharing my screen so we can all see each other.
We're starting to see some questions coming in. Feel free to keep adding questions in the chat. We have, 17 minutes. So we have quite a bit of time to go over questions. But to kick us off, I wanted to start with a question about the applicability of all of this to other loans. So Justin, I know late last year you ended up implementing, not even late, I think September of last year, you ended up implementing similar text messages for the rest of your loan portfolio. Could you just tell us about what you've seen since implementing the text and maybe how it differed or didn't differ?
Yeah, so selfishly, I wanted to run this side by side with our other loan types, all of the loan types, just because, we saw an uptick in delinquencies across the board, and that's been industry wide. And I wanted to get out in front of that. We are a much smaller institution, and a lot of those we play against, even in the credit union space. Our asset size is hovering right around 100 million total. So by all intents and purposes, total asset size of about 100 million as a financial institution puts you in that smaller category. So those changes impact us at a much more large level. So for those other loan types, we ran this same campaign almost side by side with all other loan types as well. And for early stage delinquencies, it dropped. The overall delinquencies just within 1 month between it was like 1.2 million in early stage delinquency loan balances. Our total loan portfolio is around 52 million total. So that's a huge, that's a huge change for us to allow us to, again, the targeting of knowing which members you need to reach out to that need help, and separating those from the ones that have the ability to repay, they just maybe have forgotten. That's a huge change for us. That's nothing that we take lightly when we see that type of results. Like, gosh, $1.2 million. That's a huge swing for us now. And so when we pull those numbers at month end, it was surprising. And I remember I got on a call with you all, and that was like the first thing out of my mouth. And I don't even know you all were even aware at the time that I was doing that selfishly, but I was, and here we are. So it was a good result.
We were not, and that is one of my favorite things often about partnerships is partners like, oh yeah, actually we did these other things based on our conversations. So those are some of my personal favorite things to hear about. A similar question on sort of implementing all this. How much time did it take to get this in? And I guess this is Justin and Anavik and Andrea. I think you all could tag team to answer it. How much time did it take to, get this onboarded and to start seeing results?
Yeah, I can take it first. I think from our perspective, it was identifying, in our space, we rely on a lot of partners and outside of the credit union to make these things happen. And so that's the downfall of, what we have access to in terms of being a smaller financial institution. But for all intents and purposes, our partners that we were able to finally launch this with successfully were pretty quick to pivot for us. And we stood this up fairly quickly. I'd say within 2 months, I think, was the timetable there. So that was, for me, that was moving at warp speed. Probably not for everybody else, but for us, that was for sure.
And I'm actually getting, oh, sorry, Andrea, go ahead.
Oh, I was just going to add that the application changes were kind of a separate process from the text message implementation. So like Justin said, that just required kind of working with different folks. And, a lot of kind of pivoting and tweaking based on what was feasible. But once we figured out what was possible, it was, a pretty quick process to implement. But I would say that the biggest time was in the planning and kind of figuring out what would be possible and how to do it.
All right, I'm actually getting notified that I forgot a crucial part of my role, which is to put up a quick poll for you all. These are just two quick questions. I'll put them up. And if I did this correctly, you should be able to see it in front of you. Oops, I did the second one first, sorry. So with the question we have in front of you, our idea is that we'll keep track of who wants to maybe have further conversations, and we'll reach back out. We'll also be sharing, as I noted, I answered one of the questions in the chat. We'll be sharing these slides and the recording after the fact, so you'll be able to look through those again. But if we want to get a sense of how many folks might be interested in, more details or having more conversations.
And
Obviously,
we will also include an email there as well, an email to reach out to us as well, if you do have those questions.
All right, I think I got almost everyone on this one. All right, we have one last poll, and then we'll go back to our Q&A. I don't know about anybody else, but I feel like during the 2020 to 2022 timeframe, I feel like every webinar I attended had polls. Now they've gone out of fashion, but we've kept to it. All right, I'll give the last few folks only a couple people. All right. Thank you all for answering those. I'm going to go back to the Q&A. There's two questions in here that I will bundle because they seem quite bundled. And Justin, this is definitely in your court. So, do you use an alternative credit pull program partnered with PAL? And does the PAL program provide advantages to using a from scratch or core processor program? Is there something that PAL or core could do inherently to help delinquencies?
Yeah, great questions. They're technical questions, which I love. So I was foaming at the mouth to get my answers out on this one. So alternative credit is a wildly popular concept now. We do not utilize that for this product. This product is strictly based off of their members' relationship with us, such as your direct deposits, your account usage, your how you repay other loan products with the credit union. Your relationships in terms of what products and services you have, all of those play a factor into the approval amounts or the approval in general when you apply for this product. And I know the alternative credit, is we do utilize that at this credit union, but not for this product exclusively. We do have a alternative home buyers program that we do partner with some of the alternative credit data to find approvals there, but not for this product. The advantages to using this platform that we have, and again, I mentioned early on, we partnered with QCash Financial for this to help automate this product versus doing it within our core processor. The advantages there is that we've done it both ways, and I firmly believe that this is a product that can be purely automated because, especially from the PAL program with the NCUA, you look for certain triggers to approve loans. And so anytime you have manual intervention or you have to have members come into a branch to get this service, and something we worked on and with a prior partnership with Ideas 42 around was the psychology of having to come in and explain why you need the money potentially to some folks would turn them off from even using that product altogether. And so for us to be able to automate that into where a member does not necessarily need to talk to us to tell us, this is why I need the funds, or this is what's going on. It takes that judgmental piece of it completely out of the picture, and it allows for the members to have a much more seamless use, and it actually increases the usage of that product for your institution as well. So that's my 2-3-minute answer on those two questions, but they were great questions. Thank you.
And I'll add to that piece, Justin, that on the psychology piece of being afraid of stigma or being asked questions or all that, it doesn't actually even matter what providers actually do. It's about what people expect or are afraid of. And that
Yeah.
fear or that worry might lead to someone not coming to someone in person because they're worried about it, even if like you would never actually ask questions and it's just going to be a seamless process.
Yeah, and I missed the second part of this question. Is there anything that we could be done to help delinquencies with these products? I want to go back to the changes we made to the application. That was done within those are live screenshots from what our Powell loan product looks like today. And I think the biggest takeaway, and when Andrea and team came into our credit union to help, they talked with our staff. They also did interviews with our membership. We thought initially, just from the financial institution perspective, of communicating penalties up front to us seems very counterproductive. Can we explain how this would actually be a good thing for us? And so we took a chance on it, and it worked out. And I believe that was a huge part. I mean, you saw the first part of Andrea's graph with the timeline before we even started sending these automated text messages, delinquencies were going down because we were communicating up front, like, when you use this product, here's how you use it responsibly, and here are the penalties if you don't, and communicating those up front within the PAL platform on our website. All of those things played a factor into managing the delinquencies to get them to a much more manageable level for us.
All right, we're getting more questions in here, folks. You can feel free to keep adding them. So one of them is about, do some checking account type of customers perform better than others, or do you not segment that way? I assume direct deposit customers perform better. I think everybody's a direct deposit, or not direct deposit, but it's auto pulled for the small dollar loan, right?
Yeah, so in terms of specific checking account types, and we do offer different checking account types depending on any type of past relationships that members may have before coming to us. We typically don't necessarily look at it that way, especially from a fair lending perspective. We wouldn't say, hey, I'm going to segment this type of borrower or offer them different terms based off of their checking account type. It is purely based off of the amounts and how they have performed on other products with us in the past. Now, with that being said, direct deposit is certainly more favorable. That's with any institution, right? You want what you call sticky members to utilize your products, and direct deposit is a huge way of making sure that happens. So we do prefer that, but we do allow them, like if they make cash deposits through the ATM frequently, or if maybe they don't have direct deposit and they still have payroll by check, that still does happen today. We still allow those members to be able to utilize this product.
And then we have one in here about, are there options for borrowers to change their payment due dates or for modifications due to hardships?
There are. I will say with the NCUA PAL guidelines, sometimes that can be a little bit difficult because you have a max term that you are allowed. But at the end of the day, is the willingness and the intent, the ability and the intent there to repay. If so, yes, we can change due dates for members. We can certainly help them out in a hardship, even if it makes sense for that member. We can even look at trying to convert that loan or combine that. Maybe they have other small dollar loan balances with us from other loan types or credit cards, where we try to consolidate everything into one loan for one loan payment, and to help break a cycle of delinquency. Yes, absolutely. That's the members that we want to contact us, is the ones who are having trouble, that we can find those solutions for.
I'll just jump in to add something quickly, which is that when we spoke to members, when we were learning about people's experiences, a bunch of members said amazing things about the support that People's Advantage offers and how they're so understanding and compassionate and how they really help out. So what we realized was that some members just had no idea that that support was even available to them. And that's part of why in our text messages, we highlighted kind of like, need support, call us, or no worries, we're here to help. In the loan summary, in the actual application, once people booked their loan, there was also a little kind of note that said, if you ever have issues, please reach out. So we really tried to kind of emphasize that those channels of support were even an option, because, oftentimes people had no idea, and we wanted to make sure that members knew that these really understanding, compassionate people were there to help. So that's, you can have the best customer support team, you can have the best staff, but if people don't know that that's there, or if they fear that that might not be the case, then people might not reach out.
I remember I
Right.
was in one interview with someone who his mom forced him to call, and then he got his loan modified.
Well,
All right, I want
that's
out. Sorry, Amit, go ahead.
no, never mind. I was just going to add that part of what we know in behavioral science is that when people like miss a payment, they can just tend to ostrich, right? That means they stick their head in the sand. They almost think like, oh, I've already done something bad for what it's worth, and now I don't want to reach out. So part of those text messages and including that language, maybe we couldn't say in the text message, like, call us, there's an option to skip, because like Justin said, every member's journey and like what you can do with them is different. But we did say in those text messages, reach out, we've got options. Like, we're here to help you. Call us and then we'll figure it out. To help them sort of get past that first step, which is outreach in the first place. Yeah.
All right, I'm going to close this out with one last question for you, Justin. In 1 minute or less, we actually have 2 minutes, I think. But so there's constantly innovation in this space. So can you share one key insight or takeaway from this work that you think is likely to apply in other contexts, maybe outside of small dollar loans specifically, so across lines of credit and credit reporting and such?
Yeah, for us, it's more, it's, we did this side by side just with the text messaging in general, right? And reaching out to members. And I think when we look at designing products in the future, communicating, the benefits of the product is typically all you see. And certainly we will continue to do that, but then also understanding that your client, your consumer base also likes the ability to see what those potential penalties are up front too. Like, what if I don't use this product correctly? So I think for us, being completely transparent about the entire picture of what you're offering, people appreciate that. So that's a big piece of it. And then also understanding, those, those cues that not everybody, has the same credit journey. Not everybody utilizes the same tools and things that you have in place, and understanding that you can develop your solutions around that too. I mean, we're making collections policy changes around a lot of these things. We're utilizing this in all of our other loan products that we're having and using every day. So it's changed a lot of what we do at the organizational level.
Right on time. All right. Thank you so much, everybody, for joining us. I think we have we have 1 or 2 questions left in here. If you want to follow up with those, please feel free to reach out. And yeah, thank you all so much for joining.